In today's show, my guest, property researcher John Lindeman, is going to help you solve the property investment puzzle. Clearly, in today's more uncertain environment, we know that some locations are best avoided, while others are still going to deliver good capital growth, and yet other locations will deliver better rental returns. So as a property investor, you need to understand which suburbs are going to deliver what you're looking for at your stage of your investment journey. The problem is our housing markets is like a huge jigsaw puzzle with more than 10 million properties spread over 15,000 suburbs. And it seems almost impossible with so many properties, so many suburbs to choose from. It seems almost impossible to get success. And I guess the answer is that's true because most property investors don't build the type of portfolio they want. So in today's episode of the Michael Yardney podcast, you're going to hear John Lindeman divide all the suburbs into 4 different groups. Interesting because I'd not heard this before, but it made a lot of sense. And once you understand which group the suburb you're looking at falls into, you'll understand whether it's right for you or not. Of course, it's only one part of the research puzzle, but that together with some of the other things I'm going to discuss with John today are going to give you more results and clarity in these challenging times. And then I'm going to be sharing with you 9 money lessons to teach your children. And don't worry if you haven't got children, because these lessons are probably just as important for you. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
We're living in interesting times in our property markets. People predicted the property market was going to crash, and those property pessimists, the negative Nellies, have actually probably been disappointed when they see that our property markets are sliding. They're sliding slowly, but they're not crashing. So why do property markets boom quickly but slide slowly? That's the question I'd like to ask John Lindeman, one of Australia's leading property researchers and author of Lindeman Reports. Welcome, John.
Hi there, Michael, and hello, everyone. It's great to be here.
Well, you write blogs regularly that we republish on Property Update, and I love getting your perspective because, like me, you've been around for a long time. You've seen the ups and downs of the cycle, and we all get excited when the market booms. Why does that happen, and why, at times like this, doesn't the bottom fall out of the markets?
Well, the reason that markets can boom quickly is because when things, prices are going up, everyone wants to buy properties and there's very, very few on the market. So that means it has an immediate effect on prices. They go up and you get more and more people wanting to buy as a result, so that the number of potential buyers compared to the number of properties on the market can be as much as 10 to 1. So that's why they occur quickly. When it goes the other way, Michael, it's people don't really want to suffer a loss when they sell a property, so they dig in their heels, they wait and hope that eventually a buyer will turn up. So the first signs of a slowdown are usually not prices falling, but the growth in the number of properties actually listed for sale and an increase in the time it takes to sell them.
Well, we're seeing that at the moment with fewer properties for sale. What we're not noticing, though, is desperate vendors, are we, John?
Not yet, and we hope that will never occur, but it's usually in those markets where there's a lot of investors, the old mining town syndrome where people have bought properties speculating, and of course that's where you'll get these sudden changes in demand and crashes can occur.
Well, we'll speak about the different types of market in a moment, but I agree with you. There are certain markets this time round, rather than the mining towns, it'll be those people who bought the high-rise towers and the off-the-plan properties that are going to suffer a little bit. But What can we learn from history? What's happened in past downturns about the way the market behaved?
What we can learn, Michael, is that the big setbacks that the property market has experienced, let's look at some of those, like the Great Depression. I've studied this very closely, and what happened was that prices started to fall. It took about 2 years for prices to fall by about 20%, and then they just stayed there. They didn't go up again, and there was this sort of lag that took about 2 years to take effect, and then prices just stayed where they were. Same thing with the credit squeeze in the 1960s. That was by the Menzies government, worried about the huge rise in hire purchase and housing finance debt. So they cut housing finance right back, and prices fell quite significantly for a year or two after that. But they didn't go up again for quite a long time.
Now, we're talking about times gone by when the markets were very different and the financial markets were very different. So let's move forward. What happened in the global financial crisis?
Well, it started off pretty much the same. There was a fall in housing prices, and there was this general fear. It was quite dramatic. People were predicting all sorts of horrible things would happen to house prices, falling by 30-40%. The Rudd government at the time, I think they panicked as well, and they said, let's treble the first homeowner grant. They did that, and it stopped the fall in house prices, and they actually started to go up again, but they went up by almost the exact same amount of what the grant was. And once that had happened, a year later, they started falling again. So all that did, because it was a demand side incentive, it enabled people to spend a little bit more, which is what they did.
I remember those grants were sometimes called an established homeowner boost, because what the first homeowners did was go in with this extra money in their pocket and buy properties, because sellers are buyers and buyers are sellers. And so somebody else made some money from it. This time around, though, the government seems to have learned from the past. In fact, governments all around the world have actually opened their pockets much sooner with a number of different ways of supporting the economy and the property markets, John.
Yes, I think they've realised you can't just prop up the property market, especially on the demand side, because all you do is push up prices. This is a bigger issue we're facing. We need huge economic stimuli, and that's what they're doing by printing lots of money and distributing it. And hopefully that'll enable us to recover quickly and open our borders, which will allow the housing market to get back into growth.
Well, as you were saying a moment ago, just stimulating first home buyers or certain segments of the market, it brings forward demand. So people who may have bought next year are buying this year, and then all of a sudden there's a little bit of a lull. But it'll be interesting to see what happens moving forward, what extra grants they've got. Now, we know that not all markets are going to behave the same, but they never have. And I was very impressed with one of your recent blogs where you broke the markets into 4 different groups. You explained that around Australia, there are well over 10 million properties spread over 15,000 suburbs. And you've done the hard work, and you've dug in, and you've broken them into 4 categories. Please teach us about those.
Well, the 4 categories are called cash cows, shooting stars, sleepers, and long shots. And the way they perform, let's look at sleepers first. They're the majority of the suburbs in Australia. What that means is they perform just the same as the majority. In other words, they create the performance in the market. So if you just buy a property somewhere and hope to get long-term growth, you'll end up, with whatever the median growth is over that period of time. So a lot of investors want to do better than that, and so they go for what we call long shots, which is speculative investment. They look at areas where there could be some new infrastructure project or new mine, and they're willing to take a gamble. And therefore, we call them long shots, because they may work, but they may well not work at all. Then you've got the cash cows, which are those areas where yields are very high, but there's very limited growth. So it's good to get the cash flow, but you won't get a lot of growth. And of course, the other ones, the shooting stars, these are the ones that have got it all. They're the hardest ones to find. And they're the ones that, of course, investors should really be looking for if they want to get good growth and cash flow, but very hard to locate.
So what research do you do to differentiate the different types of areas?
What we look at is the different types of households that live in different areas. So if there's a lot of renters, say ex-housing commission areas, they tend to be cash cow type suburbs. We look at infrastructure potential to see whether or not areas have got a likely increase in the renters, say construction workers coming in. We look at what the banks are doing, if they're lending money, what sort of areas they're prepared to provide more housing finance and which ones they're not. And that's really important right now because the banks are cutting back on lending into certain types of areas and they're encouraging borrowers in other types of areas.
So, John, it's not just the area, but then you've got to break it down even further to the type of properties there. But a lot of this has to do with demographics then, doesn't it? The sort of people that are there, the incomes that they're earning, and what potential there is for long-term capital growth and rental growth. I see that the middle class in Australia seems to be decreasing at the moment. And this is not a social commentary, but it just seems to be a fact to me that the haves and have-nots are separating more. And the current crisis that we're going through has shown that up even more than normal.
It has indeed. The best long-term growth in the property market has always been in those middle class, upper middle class sort of areas, well-established suburbs. And the reason for that is that people don't move very often, so they're very tight markets. And you find that they have very low unoccupancy rates, so that they're nearly all occupied all the time.
Now, of course, this isn't a judge of people, so we're not making a judgment because everyone's very important as a mother, as a father, as a human being. But there is, unfortunately, a disparity between those people who are living from paycheck to paycheck, not that we even get paychecks anymore, and those who've got multiple streams of income coming in. And that's been shown in particular recently as people have lost their jobs or are not working as much. So those areas where people have got high disposable incomes, more income, multiple streams of income, some share dividends, some property investments, and have probably owned their homes for a long time and therefore don't have as big a percentage of debt, they're more likely to be the higher rent, higher growth areas. Would that be fair?
That's right, indeed. And they're the ones that the banks are more likely to lend to because they provide or present much less risk to the banks. So they're the areas at the moment where the demand is high. We're looking at the areas, sort of well-established inner urban suburbs, houses in those where prices are holding up quite well and even going up.
Interesting. You say they're attractive to the banks. Hey, we've got to listen to that because they do all their research and they know what's going on and they know what people's household incomes are. And while there hasn't been a lot of mortgage stress, as we said earlier on, or financial stress, that could well come as we move into later this year into next year. And that's more likely to occur in those lower socioeconomic areas. So I like buying in areas where there's a higher percentage of owner-occupiers, like you said, while if you go to the cash cow areas, you're probably going to find there are higher rental yields and more tenants. But a lot of the tenants there are renting because they can't afford to buy, while in the higher socioeconomic areas, John, they're renting more for lifestyle reasons.
That's right. And of course, right now we're suffering from the results of the pandemic and the economic problems that's developed. But what we're finding is that areas and people that work in, say, recreation, hospitality, transport, tourism, all of those areas, they're really suffering. And unfortunately, a lot of those people are renters. So we're seeing that the rent demand is falling as a result.
So again, if you're going to become a property investor, you should have a strategy. You should know what your plan is. And in my mind, it should actually be for building your asset base and capital growth. But I know some people like to invest for cash flow. And so that's what you should be looking at. What are the areas that you're investing in? What is it that that area is likely to offer. And over time, John, those areas really don't change much, do they? You're never going to move Penrith into near the bay in Sydney or Dandenong close to Port Phillip Bay.
No, you're not. And of course, the bigger our cities become, the more precious and rare those special suburbs are, because there's only, if you look at, say, Melbourne, there's only so many middle parks and places like that. But the outer suburban areas around Pakenham, Cranbourne, Melton just keep on growing and growing. So those areas that have got something special about them are becoming proportionately rare, and so their value increases as a result.
Well, moving forward, what's going to push up property values? What's going to push up rents? It's going to be the ability for people to buy properties. And in many of the outer suburbs, as we've said, they're having a bit of difficulty financially at the moment. More than that, it's unlikely wages are going to go up in those areas for a long time. On the other hand, in the more affluent, more established suburbs, there are going to be more people who can afford to upgrade their home, do up their home, buy a bigger home, because they've got multiple streams of income and more certainty of income, John.
That's right. And I think we will see over time the old trends that we've seen in the housing market, they'll be there again, and they won't. We've had a bit of a change, but it's a temporary one, and I think the long-term trends will reassert themselves.
Yes, and I guess we're looking for that. So despite the air of uncertainty at the moment, if you want to get involved in property investment, it's really important to understand this type of research. And really, demographics is going to be one of the biggest factors of what makes some areas do better than others in the long term. More so, as you say, John, than the short-term ups and downs of political uncertainty, COVID, or the other things. It's how many of us there are, how we want to live, where we want to live, and what we can afford to do. So if you want to find out more about this sort of information, I suggest you go to Lindeman Reports, where John has a lot of great blogs, but you actually dig much deeper, John, and you do a lot of reports that people can buy. What's the most popular of your reports? What's the most useful for property investors?
Well, we're about to produce a report called the Shooting Star Report, where we've identified those areas that we think have got the best growth potential. They're coming out in a few days. So hopefully by the time this is out, they may be out as well. We haven't actually produced any reports, and that for a long period of time. It was a conscious effort. We said, until we know exactly what the fallout from the pandemic and the economic consequences are, we just won't do any reports. I think we're now at a position where we can see what's likely to happen.
Well, the Shooting Star Report, I like the idea. I'm going to buy my copy of it, and I'm going to put a link in the show notes, John, so that people can find out as well, because that combination of high growth and the ability to get higher rents is going to underpin the performance of your investment. Actually, it's going to take a lot of risk out, because there are still going to be risks. We're not wanting to downplay that. We're not going to get over all of this for a while. So if you can minimize the risks by having a property that's going to be in strong demand by owner-occupiers and by tenants, that's the way to go. Makes sense to me. Thank you so much for your time, John.
Thank you very much, Michael, and thanks, everyone.
Well, as always, John Lindeman gave us some insights. I like the concept of the different types of markets and the different performances of properties. So it's going to be important for you to understand how that fits in with your stage of the journey. Now, I want to discuss that a bit more in a sec, but just also remind you that in a moment, I'm going to share with you 9 lessons to teach your children about money. And even if you're not planning to have children in the near future, or you haven't got children, doesn't matter. These lessons apply to you as well. But back to John's thoughts about the different types of property performance. It depends where you are in your property journey as to what type of property would best suit you to get you to where you want to get to. Can you see how it's important to have a plan, to have a strategy, and not just go out and buy a property, because doing it that way gets you the same results most people get, and that's not a good look, is it? So at Metropole, my team specialise in starting off giving you a strategic property plan, which includes a finance plan and, depending upon where you are in your journey, an asset protection plan and an ownership structuring plan and estate planning for some people as well. Having said that, it all starts with knowing where you are, knowing where you want to get to, understanding your timeframes and your risk tolerance. So go to metropole.com.au, because I believe in these uncertain times, you need strategic advice to give you direction, results, and certainty. That's what you're going to get from my team. They're going to help you outperform the average property investor. And in the last year alone, I'm really proud we've won 3 separate awards as Australia's leading property consultants. Go to metropole.com.au, have a chat with my team, and let's see how we can help you take advantage of the next stage of the property cycle. I'd like to have a chat with you about 9 important money tips to teach your children. Hey, but don't worry if you don't have children yet, or you're not planning to have any, because maybe these money tips will be useful for you, because you were somebody's child once, weren't you? Now, when I think about it, there are so many events, decisions and occurrences that I look back on over the years and think, wow, if only I knew then what I know now, how different things would have been. Well, it's too late for me, but one of the most important things we can do as parents, and now me as grandparents, is to equip our children to manage their lives more effectively. And one of the things they should learn about is money management, because most people don't teach that at home. Seemingly, though, many of us are reluctant to share our mistakes with our children because we're worried that they may think badly of us. In fact, most Australians don't teach their children anything about money, meaning we raise our children to be financially illiterate. So is it any wonder that most Australians live, well, they used to call it paycheck to paycheck, but you don't get a check anymore. But I guess pay period to pay period. And isn't it any wonder that most Australians never accumulate many assets? In fact, they accumulate more debts than assets. What's worse is what our children are being taught by not just the parents, but the school system, politicians and the media. They're teaching our children that the wealthy are greedy, they've got too much money, and this wealth needs to be redistributed. Well, I think that's wrong. But what kind of a message do you think that sends to our future generations? So I thought today, as a father of my own, now adult children, and a mentor to many budding property investors, I'd like to take a moment to share 9 important steps that you can give your children to make them more financially in control and independent. And the first lesson I'd like you to teach them is that today's debt equals tomorrow's slavery. When we are young, we tend to think in very narrow time increments. We seek immediate gratification and often don't like delaying things. And in particular, don't like delaying the purchase of things that we really, really want. Now, unfortunately, this leads a lot of people into a credit trap, where they borrow money using their credit card, thinking it's their money, it's not, it's the bank's money, so they end up paying high interest rates, or they get personal loans and only end up paying back thousands of dollars in interest, or forever owing people money. But the fact is that today's debt is robbing them of tomorrow's earnings because they're sacrificing the money they don't even have yet. Limiting your debt obligations when you're young means you're going to have more control of your personal finances later in life and avoid financial hassles, those financial chains that bind you and stop you getting the freedom of the life you want. So the first lesson you should be teaching your children is that today's debt equals tomorrow's slavery. Another important lesson to teach them is that he who dies with the most toys isn't the victor. Now, look, we all like our toys. Well, I know, at least I do. But the expectation of having a lot of toys is a dreadful enemy of money management. We end up seeing how the other half live, with Instagram and social media and Facebook, or in the magazines or on TV shows. Reality TV isn't real, but it makes us want to live like them. It makes us think that that's what life's all about. No, that's not true. Consumerism is the new black that won't go away. The truth is, possessions don't make for a rich life. It's the experiences you have, the people you spend your time with, the things that money can't buy. That's what truly makes you wealthy. You've probably heard me say it before, true wealth is what you're left with if you lose all your money and all your possessions. So the second lesson to teach your kids, or maybe you, is that it's wrong to think that he who dies with the most toys wins. Not true. The third lesson is take responsibility, and that'll make you the master of your own destiny. Fact is, there's no such thing as rich victims. However, unfortunately, people are too quick to blame others for their own perceived failings in life these days. We've all become a society of litigious finger pointers, and as a result, many people feel they're being unjustly dealt a bad hand. The truth is, if you're courageous enough to cast a critical eye over your life, recognise that you are where you are now as a direct result of your own choices, and then you take ownership for your decisions, that'll help you build confidence, self-esteem and self-respect. You've got to recognise you are where you are right now because of all the decisions you've chosen to make and the decisions you've chosen not to make. So the decisions you make today are going to decide where you are in the future. It's a cause and effect relationship. It's not the world that's going to change. You're going to have to. So you've got to have the inner strength in knowing that you're the master of your own destiny rather than handing over power and control to somebody else. Let's face it, they're not going to have your best interests in heart the way you do. Third lesson to teach your kids then is take responsibility, and that will make you the master of your own destiny. You've got to be the pilot of your life to get you where you want to get to, not a passenger just along for the journey. The fourth lesson is that of patience and waiting. Teach them that when they fly the family coupe, no doubt they're going to want everything. They're going to want a car. They're going to want a good job. They're going to want the latest electronic gizmos. But in all likelihood, they'll have to work their way up the food chain, learning to prioritise how you make best use of the fortnightly or weekly money that comes in. So they've got to understand the difference between wants and needs and recognise that all the money that they spend on those material things that they just had to have today is less money that they're going to have to fund their future years and their retirement. But they also need to know that if they work hard and invest even harder, their purchasing power will increase over time. So one of the important lessons to teach our children, and ourselves if we haven't learned that, is the concept of delayed gratification. The fifth lesson to teach your kids is luck is made through hard work. Many of us like to attribute the success of others to good fortune, to luck. Now, maybe they were in the right place at the right time, or they knew the right person. So while a handful of people have lucked out by winning the lottery, truly successful people have done the hard yards to reach the pinnacle of their chosen field or their endeavour, or being successful investors as well. So if you can find something that you're passionate about and make a living doing it, you're going to be far more likely to achieve great things because you're going to work harder to reach your goals. Every day won't be a struggle. So luck is when you are in the right place at the right time and recognise it because you've prepared yourself to do that. The sixth lesson to teach your children is you don't need millions and millions of dollars to achieve financial freedom. I know there's lots of property investors up to their eyeballs in debt. Many of society's rich and powerful players are asset rich, but cash flow poor. Some people I've seen as clients of Metropole have actually built substantial property portfolios on what others would suggest is low incomes. And boy, have I seen a lot of professionals with very, very high incomes spend more than they earn even at those high income rates and not have anything to show for it. So financial freedom isn't really dependent upon how much you earn, but on your relationship with money and your level of personal responsibility and money management. And I guess, as I said a moment ago, delayed gratification, making sure that you spend less than you earn, invest it, keep investing it, letting compounding and time and leverage work its magic, and then you're going to have an asset base to live off. So that brings me to the next lesson to teach your kids, which would be spend less than you earn and invest the rest. Now, I've already just said it, but if you follow that golden rule, and boy, it sounds simple, but don't downplay the simplicity of it, you're going to be able to get towards that path of financial freedom. So how much should you invest? Well, it really depends what your personal exertion income is and how much spare money you've got, but at least 10% and even more should be put aside even before you spend anything else, just like the tax man takes their money out at the beginning of the month because they know that they're not going to be able to get it out of you at the end of the year. So spend less than you earn, save it, invest it, and over time you'll build wealth. I guess the last lesson I'd suggest you teach your children, like I'd like to teach mine, is your youth won't last forever, so use it wisely. Now, interestingly, in the early years, if you do start investing, compounding will actually, over time, make even those small investments that you make early in your life when you go to start working, it'll make them quite a large asset. So we tend to see a lot of people at Metropole when they're 50, 55, 60, and they suddenly realize, hey, I'm going to retire soon. I haven't got anything. On the other hand, those who start early and have a long runway, even if they make some mistakes along the way, they are the ones that accumulate significant wealth. So the lesson to teach your children is start saving and investing early in life, and you're likely to secure your financial future. So the message I'd like to give you at the end of this little chat is that wealthy people do certain things every day, every single day, that sets them apart from everyone else. They've got good daily success habits that they've learned from their parents. And these habits are the reason for the wealth gap in our country and the real reason why the rich keep getting richer. Now, we're likely to be the only mentors and most likely to be the most influential mentors our children have. Think about it. The apple doesn't fall far from the tree. Now, you may say, no, it's not. I'm not like my parents. Well, have a look at your partner, your life partner, your spouse, your husband, your wife, and you'll see that, hey, yes, the apple does not fall far from the tree. You become more like them as you get older. So unless we teach our children good daily success habits and that way level the playing field, the rich will continue to get richer and the poor will continue to get poorer. So it might just literally pay to give them a bit of your time, a bit of your wisdom, and teach them these money lessons. As we're getting near to the end of today's show, I'd like to say thank you for listening in, and I hope you got some benefit from it. And if you did, please help me in my quest to make more Australians financially fluent. I believe everyone in Australia, and wherever you are in the world, deserves to build more wealth. It's the way we're going to get ourselves out of this slump. And by you owning another investment property or being more successful in your business doesn't stop anyone else doing that. So for that reason, if you got some benefit, share this episode with somebody. Please leave us a review on whatever podcast app you're listening to, but use the share button on your podcast app or just tell somebody about the Michael Yardney podcast, and let's get our country moving forward. Look forward to catching up with you again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?